Hello everybody. So this is my first impressions for the Q3 2023 earnings report from Enphase that was just released about 19 minutes ago. So I have not looked at the stock price ever since the report, and I haven't looked at the news, I haven't looked at social media. I don't know where the stock price is right now because I want to give you my impressions without even knowing what the market is doing right now. So I have no idea. There's no pre-inputted idea from the market. I'm not reading anything. This is just my commentary, not the commentary of anyone else. And I have no bias because I don't know where the stock price is. I'll tell you what I think. So, as far as revenue growth, I would say nice save. The catastrophe as far as the revenue growth for Q3 did not happen. They've saved their Q3. They have a 551.1 million of revenue in Q3. It's down markedly compared to Q2, but the guidance was between 550 and 600 million. So they are within their guidance. So as far as I'm concerned, of course, I would much rather see them much higher in the guidance. But I'm okay with that. They've met their guidance. The market should not be surprised on this. So moving on. So this is rather neutral, right? They've met the guidance. They've done their job on this one. Moving on though to something excellent, which is these gross margin. My thesis on the IRA making their margins entirely blow up is playing out. If you saw my Sunday video about how much money they're going to get from the IRA, it's not even funny. Well, it's already starting to show in the margins. Their gross margin right now is a 48.4%. This is well above the high point of their guidance. Their guidance was 45%, now it's 48.4%. I think a lot of people are overlooking the benefits of the IRA to this company, which is something that SolarEdge, for example, does not benefit nearly as much. I mean, we're talking about a company that's nearing 50% margin. I think this is outstanding. This is a number to be celebrated. As you know, I like gross margins, but I prefer revenue growth. For me, revenue growth is the most important metric, but there's lots of shareholders out there, lots of value investors who love margins. So I think this will play positively among a lot of value buyers who want to see money being made. This is an example of money being made when you have margins like that. Let me move on. The softness. So they've experienced softness in the third quarter, right? With a decrease in sales due to macroeconomic conditions. Interest rates, may I remind you, mortgages are more than 8% right now in the US. They're high all over the world. You have 16% decrease compared to the second quarter and 34% decrease compared to the second quarter. As far as I'm concerned, this is not as bad as feared and not as bad as what SolarEdge intimated when they did their revision on their deliveries a few days ago that led to a major drop in the stock price. So as far as I'm concerned, this is bad, not as bad as feared, as far as I'm concerned. Now, when it comes to the IRA benefit, like I said, there will be much more money coming in from the IRA, and they keep highlighting this right here, and that's going to be very good. And I suggest watching my Sunday video if you haven't watched it, where I talk about the IRA. Now, where I think they did really well here, really good, Enphase is a well-managed company. Look at this, right? In Q2, they had a $1 billion buyback. And, some people may focus on 129 and say, oh, they overpaid. They paid 129 for the stock, which, I'm pretty sure it's not up 30% right now. So it's likely, it's likely still, I think the stock is likely down right now. I don't know. But it may look like they overpaid. But they did not, because this is what's important. They only spent 110 million. Right? So if you look at prior quarters of their buyback, their average was 250 million. They've only done 110 million, which means that they have almost 900 million back in their buyback right now. Almost 900 million back. So this is a very well-managed company. And if I didn't know any better, I'd say they're going to buy much more of their own stock this quarter now that the stock is trading at under $100 a share. under 100, right? I think this is great that they didn't go all in when it was in the 120s and that they wait to buy when it gets cheaper. This is a sign of great management. Now, and unfortunately, I kind of have an intuition as to where the stock is right now, because there is some disappointing news, which is the guidance. Their guidance is between the range of 300 and 350 million, and this is not good. There's just no sugarcoating it. This is not good. That means the inventory is not selling through at their distributor, and there must be a major economic downturn going on in Europe. I know Europe is where they're struggling the most, and then in the US, despite the subsidies, there must be a major economic downturn in solar right now, because we thought it was inventory channels, right? And we thought inventory channels would normalize, and they have not normalized. They're guiding a whole bunch below. The guidance was 550 to 600 million for Q3. I mean, that guidance at 300 million, it's way too low. It's extremely low. So I don't know if they're sandbagging, or I don't know if there is, really that much of a slump. I mean, it tells you interest rates are crazy right now. And so yeah, a lot of people are not buying solar. So I think the stock is going to be down. If I were to take a guess, the stock is going to be down quite a bit right now because of this guidance. And the market is only going to look at the guidance. But then, the question to ask ourselves is what's going to be the explanation for this drop in the guidance in the call? What is going to be the explanation? In the call, they tell us how many of these microinverters come online. They can see live how many of these microinverters come online. This is a stock that is dropping. Will it be like a coiled spring whenever interest rates go down more? But this is right now. I think this is a stock whose depreciation is going to be depressed, right? Especially in this market. I mean, may I remind you, today was like, if you add the Nasdaq, the past few days was like one of the worst weeks since I think February for growth stocks. So this is definitely not the good environment. This is going to add to the negative mood, and I'm definitely disappointed by this revenue guidance. But I'm waiting to see the explanation. The one thing I wanted to say is, okay, so we have a major drop in guidance, right? And so the question is, are we going to see a drop in the stock price equivalent to that drop in guidance, or is that going to be even more, right? But in my view, the short-term holders of this stock, which remember, most of Wall Street is very short-term. Analysts give their estimates 12 months out. Most of Wall Street is very short term. My view is they're not going to like this because this is significantly lower, and there could be a chance that they're sandbagging. But I wouldn't hope. I wouldn't change my hope to this. I will not sell any of my shares. I'm a long term shareholder. To me, this is a 2030 and later stock. This is a stock that will shine in 2030. That's why I invest in. But it may be bad right now in the stock market. So I haven't looked. I will look after I'm done with this video and getting ready to listen to the conference call. Gross margin is excellent. Like I said, this is why the shareholder base of this stock may change because of the gross margin. This gross margin is excellent. At 51%, they're guiding up to 51% gross margin. So the IRA is going to keep coming in and keep making up for that. Well, not entirely, but some of that makeup in revenue, I think, is going to be made up by the IRA. And remember, they beat their gross margin this quarter by quite a bit. They might beat gross margin again. So, are we going to have a stock that sells 30 or 40% less, but makes 30 or 40% more because of IRA benefits? Could be possible. This gross margin right there, in my view, is the reason why a stock like Enphase is trading twice as much as a stock like SolarEdge. And battery, and this is my conclusion here, battery clearly has a different strategy from Tesla. Tesla is dropping prices. All of these financed products, these financed items, Tesla is dropping prices in order to grow. Battery's not doing that. He's not dropping prices. He's keeping the prices high, focusing on the margins, and he's not doing that in order to grow. And so this begs a question as far as price elasticity. How much of a price elasticity is there for solar? Battery would suggest there's not that much price elasticity, such that dropping the prices would not increase the sales tremendously. This is what I seem to be reading into battery, holding prices high, and those margins going up is definitely something Wall Street should like. But me, as a growth investor, I don't like to see that. And this is. This is also important in Wall Street. Stocks that are predictable, that have predictable revenue growth, tend to be valued more than stocks that don't have predictable revenue cycles. And Enphase, is it's a sort of a semiconductor industry in the way that the product works and in the way they define it, and they are going through some cyclicality right now, in my view. So, anyways. For this company, the call is the most important thing, and I will listen to the call with much interest. So I look forward to reporting on the call shortly. Thank you so much for watching. This was obviously not investment advice, just entertainment. I appreciate your likes. I appreciate your subscribes. Have a wonderful day. No matter what the stock does, this is a long-term thing. No investment advice.